Hi, it's Riz from R3 Mortgages, and while my wife has gone out and I've got the place to myself, I just wanted to share with you my thoughts on why trackers are going to gain in popularity and why fixed rate mortgages have been the flavour of the day since the credit crunch. Now, as you can see on this beautiful graph by the lovely people over at the Bank of England, it shows you since 2013 to the current time the UK base rate. Now, for the purposes of my illustration, I am going to assume that during this period of time, forgetting about the short-term variability, let's say you could get a 5-year fixed rate mortgage for a couple of %, okay? So before anybody starts on me saying that I know that fixed rates aren't anything to do with the Bank of England base rate, they're to do with swap rates, etc., etc., for this thing, we're going to keep it simple. So let's assume that you could get 2-year money for 1.5%, let's say, and 5-year money for 5%, for 2%, during this period until mid-2021. Okay. Now, after the credit crunch, 2007-2008, interest rates in the United Kingdom dropped like a stone. And as we pick up this graph here, we've been in a prolonged period of low interest rates in the United Kingdom. Hands up who agrees with me. Thank you very much. Thank you very much. Okay, so we've had very low interest rates in the United Kingdom here. So while you have had a low base rate, and let's say by the time lenders have put on a margin with the fixed rates, they're up to here or whatever. If you take a fixed rate mortgage from here onwards, you know that if rates go down, then potentially you could be paying more, because had you had access to that downward movement, then you could be saving money on your mortgage. But there is the propensity for the rates to go up in the future, and not only by, let's say, circa 1.5 to 2%, where you've got the downward momentum, they could go even higher than 3.5%, 4.5%, 5.5%. I remember when interest rates were 15, 16%, those types of rates. Okay. Now, with tracker mortgages specifically, after the credit crunch, a floor was placed on a lot of these products. And what do I mean by a floor? Now, a floor is a rate that even if base rates come down, the pricing of the product won't be less than that amount. Okay. Pre-credit crunch, when I was still working in financial services, when I was working for a bank, I'd arranged some mortgages at that time that were lifetime trackers at 17 basis points above the Bank of England base rate for life, with no floor. So what happened when the base rate went down on those old contracts to 0.5%? You had some people on those particular products, and I think that was the lowest at the time that I'd ever heard of, paying 0.67% on their mortgage. Great times, fantastic times. But obviously, after the credit crunch, lenders cottoned on to this. They'd never expected such a sharp drop. It happened. They factored that into the new contracts. So while the rates are hobbling down at this level from there onwards, with trackers, with floors, you could apply the same principle to discounted rates. By looking at fixed rates, there isn't as much benefit on the downside. Sorry, there isn't as much benefit on the downside than there would be at the upside. So it would make sense that a lot of people would want the stability over the term of their particular product for the rates to be steady versus, let's say, some of the alternatives. And I'm talking generically here, this isn't advice, blah, 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 blah. Now, when you start seeing a spike in the mortgage interest rate, and when you start seeing fixed rates, which are priced based on swaps, at a sizable premium over where, let's say, the current rates are, that's where tracker mortgages and the other associated variable rate products come back into vogue. And they come back into vogue because although there is the propensity for rates to go up in future, there is also the propensity for rates to come down. Now, nobody has a crystal ball, And I honestly think that we're going to go in for a period of pain. But if we do go in for a period of pain and the economy is not growing, reducing interest rates could be one metric to stimulate the economy, especially if interest rates fall, and being a cynic, as close to a general election that we get. So this is why at this level where the rates are, variable rates, discounted rates, tracker rates, become more part of a conversation as opposed to fixed rates that still have a premium on them. Thank you very much to the person who may not be named. A number of tracker products on the residential and the buy-to-let market also currently have no early repayment charges. So if the market does turn, that leaves you an element of flexibility, but you need to factor in the cost to change, etc., etc. So very quickly, that is the reason why a lot of people may not be familiar with a lot of the other types of mortgage products, or may have not heard of them being mentioned as much as fixed products. And that's the reason why now they may become more apparent in your conversations, especially if you're looking to remortgage or take out a new mortgage. And it is always, always, always important to sit down with yourself or a suitably qualified professional and see what are the best options for you at this particular moment in time. My name's Riz Malik from R3 Mortgages. That's my quick recap on why fixed rates have been in vogue, and you may see more of the emergence of variable rates, trackers, etc. Thank you very much.